Hi, everyone. This is Aziz Yusuf and Alex Escobar on Screw the Stock Market, the show where we learn how to build wealth and learn how to invest outside the normal standard stock market strategies. And today we have quite the show for you. Isn't that right, Alex?
We do. It's a really good one. I hope you guys enjoy it and get a lot from it. It's a really cool one because this is a virtual family office, and what they do is they take a very holistic view towards wealth building and asset protection. So there's a bunch of really specific, tangible lessons that we can take and apply to our own financial management. But more than anything, it's just very resonant with the idea of screw the stock market. And I think you're gonna love it. It was just awesome. And I think for me, the big key takeaway is, the whole premise of this show is that there's information out there that the wealthy have access to that helps them to build wealth and grow their wealth, and the rest of us don't have access to it. And their service is exactly built around that.
Yeah,
It's
they're
exactly
essentially
that.
they're essentially financial advisors on steroids. Basically, boutique shop that focuses on everything. So in one place, you have all the different types of advisors you need, from attorneys, accountants, everything and anything, all in one shop, all focused on your one particular portfolio. So it's really awesome, and you feel like you're among the ultra elite, while still being a normal Joe Schmo.
Yeah, so
Uh,
really enjoy the show, and thanks again to Kwesi Robotham. Hi everybody, welcome to Screw the Stock Market, where we talk about financial freedom and alternative investments outside of the stock market as ways to build wealth and attain that freedom and quality of life and lifestyle that we're all hoping for. Today we're excited to welcome Kwesi. I'm not sure how to pronounce it. Robotham? Is that correct?
Robotham.
Robotham, okay,
Yep.
and Jim Roessner. Both of you guys are from Kingstowne Advisors and we're excited to learn more about what you do and get to know you guys even better. So, welcome to the show.
Thanks, guys.
Yeah,
Appreciate it.
thanks for having us.
So, tell us a little bit, the first segment we usually like to just get a little bit personal. Tell us a little bit about where you guys came from and how you got to where you are. Beautiful.
Yeah.
Well, we're glad to have you guys. So I guess I was gonna say, oh, they're both 3 hour drives, 3 hours away, right? But that's not true at all. Uh,
Yep, yep.
so let's get into it. So tell us just, maybe what is Kingstowne Advisors? I think that would be a great place to start.
Sure. You know what? Let me back up a little bit before
Sure.
we jump into Kingstowne Advisors. In a nutshell, and I'll get us there, but in a nutshell, we're a virtual multifamily office. That sounds like a mouthful, but I'll explain what that means. But as I was saying, we didn't start off in financial services by any means. I was actually having a great time being a management consultant, but then in July of 2008, my wife and I had our first son just before the financial crisis. We timed it perfectly in terms of increasing our household expenses, right? Bring another human being into the world. and about 20 months later, we had our second kid. That was December of 2010. So we're still in the middle of financial crisis. We've got two kids. 6 months later, we're sitting down doing a mid-year review with our financial advisor at the time. And my 401k is bleeding money. My wife's TSP, she's active duty Air Force, so her thrift savings plan was losing money. And I had one question for our advisor, and he was he was working for one of these firms on the top floor of a building in Cincinnati. You walk in, Alex, it's all mahogany tables, high leatherback chairs, the whole deal, right? And I had one question. I said, look, I don't like being exposed to all this risk, right? By the way, the brand of management consulting that I did was risk management, right? So I said, I don't like being exposed to all this risk. Do you have any other alternatives for our retirement savings? And his answer was, well, yeah, we can look at rebalancing your portfolio to a different allocation of stocks, bonds, and mutual funds. That probably sounds familiar to you guys. And I realized then and there that either he didn't know any other alternatives. Or number two, maybe he didn't think we had a high enough net worth to qualify for the special sauce information that he reserves only for, his best A clients. And so I decided then and there I was going to figure out how to grow money without losses, right? How to save for the future without all the exposure. And I ended up backing into the whole financial services industry. It was a few years later on that, after starting and running a couple other businesses, that I founded Kingstowne Advisors. Along the way, met Jim. We actually met. We were both working at another. He actually recruited me to another firm a few years back. Turnabout is fair play, right? So I ended up recruiting him and the Kingstowne Advisors a couple years later, and sort of that was all she wrote. Jim, anything you wanna add about that?
Yeah, and it's been pretty much my story, starting off in the voluntary benefits world as I share. But my path was a little bit different, where I started in the from there to the financial planning and financial services. So I kind of got a good field of that space, right, from the Black Rocks, from the American funds, and learned and sucked up all of that juice. And then again, when Kwasi kind of returned the favor, and we're looking at these things where it's like, wow, hey, you can grow your money in the market, but never risk losing that. I was on three different financial planning teams, and none of them were talking about that, right? We were getting all these firms to buy me lunches every month or whatever, and nobody was talking about that. And that was kind of my aha moment of kind of the whole why people feel they need to be in the market, because they've been conditioned. Hey, you got to be in there to get it, to take on this risk, to grow your money. And that's ultimately when I got back with Kingstowne Advisors. It just made a lot of sense. I was able to bring my financial planning experience over here to what we're doing, and it's been great ever since.
Yeah. So, back to what you were asking, Alex, what in the world is Kingstowne Advisors? What is a virtual multifamily office? Here's the deal. Um, there are, there's about $6 trillion in wealth right now controlled by family offices. That's more than the entire hedge fund industry combined globally, right? So what is this thing called called a family office? Well, it turns out that the ultra high net worth, they don't have a CPA firm that they go talk to get tax advice, and then run to an asset protection or estate planning attorney to get legal and wealth and estate planning advice, and then go talk to a financial advisor to get tips on stock trading, and then go talk to an insurance guy. What they do is they'll set up an entity whose sole purpose is to grow and preserve the wealth of that one family, and they'll hire um, as a full-time employee the CPA that they know, like, and trust, the asset protection attorney that they trust, the financial advisor. They might hire a CFO to oversee any of the operations of any business interests that they own. Maybe an insurance guy that they'll have in house, or a chief investment officer. And the whole idea is to streamline the entire operation of growing and preserving the wealth of that one family. And what happens oftentimes is a handful of families might pool some resources together to benefit from economies of scale. And instead of having a single family office, they'll have what's called a multifamily office, right? Where we're a little bit different is that, and especially based on our own experience, we're not catering to the folks that already have tons and tons of cash in the bank, right? The super ultra high net worth. What we're doing instead is we're bringing the same experience and process to affluent and emerging affluent business owners and executives to accelerate their ability to even get to that ultra high net worth status. Does that make sense?
Absolutely. That makes
Yeah.
a lot of
Sounds
sense.
amazing.
Yeah.
Yeah.
And, you know, yeah, I think especially as you start to make more, a little mistake, I can see, like I've done it. I'm busy running my business day to day, and oh, I forgot to, check a box on the taxes, and oh, there's a little penalty here or there. And for me, that's annoying, but I can imagine as you get more and more wealthy, there's more zeros behind a little penalty here and there.
That's
Um,
right.
And
You hit the nail on the head. So let me give you an example that we like. So if you look at the healthcare industry right now, especially these large HMOs, they've moved to a similar model. Ideally, your primary care physician, if you've got something that's bothering you, if it's something, routine, run of the mill, that primary care physician can probably treat the situation. But if there's something a little bit more serious or the impact could be potentially greater, they're going to bring in a specialist, a cardiologist, gastroenterologist, dermatologist, whatever it is, all the specialists. But they never say to that cardiologist, go forth and conquer, good luck, and hopefully you treat the client well. They'll never do that, right? They need to know and make sure that whatever the cardiologist is recommending is reported back to the primary care physician, and we keep all the specialists on the same page, and there's integrated reporting, there's collaboration, there's making sure that whatever we're recommending doesn't have contraindications over here for something else, because not doing that could be deadly, right? And same thing, as you start to accumulate more wealth, what your CPA might tell you to do could destroy your asset protection plan that your attorney is put in place, and could be have its own contraindication with what the financial advisor is telling you to do. So you need to have all those guys on the same page, right? And what we find though is rarely, if ever, does a business owner or an executive, does their CPA even know the name of their financial advisor, let alone been on a conference call with them together.
That's very true. I mean, unless you've got like big money, as you say,
Right.
That's never going to happen.
That's right.
And that's what's interesting too, is that you don't even necessarily need to have big money, right? Like it could be anyone off the street that says, "Hey, I'm filing my taxes. Can you chat with my financial advisor guy?" It just never crosses people's mind, right? And it's kind of funny from our position because people are doing this 10 times every day in their health space, right? Kind of with their health care, but not for their financial care, right? So that's kind of where we're trying to help people and bring that there.
And I think people, not only do they not know to ask this, but I feel like they probably feel intimidated. I mean, they feel like if you ask your accountant to speak to your attorney, they'd be like, why would they want to do that? They're just going to tell you no.
Yeah. Well, and it's sort of a symptom of the way the whole financial services industry is. I mean, in our opinion, that the industry is kind of broken, which is
feel
okay.
free
It
to
creates
hate.
opportunity for us, but that's just the deal, because there's so much competition, right? And very few folks think in a collaborative manner, that your financial advisor is not going to want to talk to your attorney because they might feel threatened,
Right.
right? But we remove that, right? And one of the interesting things is working with a client and letting them know that, look, if you've got a financial advisor that you like, that's doing a great job, we don't want you to get rid of them. Keep them in place, but let's bring them in a larger conversation, right? So we can, because the whole point is to make sure that as fiduciaries that we're doing the best for our clients. And without that collaboration, a lot of times some really important stuff gets missed.
That's very true. That's very true.
Very
But
interesting.
there's also the fear about the cost. I mean, having so many different professionals working for you to try to protect you, it's going to sound expensive. I mean, that's again one of the reasons why it's something that's in the realm of the rich normally.
Right, you got it. And so, just to be upfront, your traditional normal family office, it costs at least $1 million a year to operate, right? And that's why the average person hasn't even gone that route, because it's normally the realm of the super wealthy. Like, you're going to spend $1 million a year just to organize how you manage your wealth, right? So that's cost prohibitive to most people. Thankfully, there's technology these days, right? There's outsourcing. So we'll leverage technology, we'll leverage outsourcing. We've got a team of about 50 different specialists that are top-notch people in tax planning, legal and asset protection, business advisory, wealth management, risk management, and all those different domains. But we don't run them on our payroll, right? We bring them in as needed based on what the client needs, and that allows us to drive the cost down, and we pass the savings on to the client that way.
Very interesting.
Sounds
Okay.
good.
So I love the holistic approach. Can you share just maybe some examples or maybe lessons that that the audience could take as things that we could either attempt to implement in our own finances or maybe things to avoid?
I'll start with an example that I think is available almost no matter what your level of wealth is right now. And it's around, okay, so let me say it this way. If I told you that you could put money in an account and it could grow tax deferred, right? And regardless of whatever the market was doing, you'll never lose your principal or your earnings or your return along the way, right? And at some point in the future, when you wanted to get the money out, you could get access to the money completely tax free, right? Would is that something you think would be beneficial to the average person walking around out
Yeah, most definitely.
That
there?
sounds like
Absolutely.
a
So
winner.
you can grow the money without risk. You can get decent growth. You have no exposure to market losses, and you can get all the money. You can get access to the money completely tax free. Right? Sounds like the best investment account that's ever been invented,
Yeah.
right? But the challenge is when we say to most people, well, that's called life insurance, there's like a disconnect in their brains. It's like file not found. What do you mean it's life insurance? I thought life insurance was, the money that I get that my family gets when I die, right? And it's funny. I remember being maybe a few years younger than Jim, like 24, 25, sitting down with a guy, and he says he wants to sell me a life insurance policy, and I said, wait a minute, I'm an engineer. I was really arrogant, right? And I said to him, wait a minute, uh, let me get this straight. You want me to spend money on something that I can't use until I die? He's like, uh-huh. I said, okay, I got a piece of the Brooklyn Bridge I want to sell you too. Right? Because that's how we're taught to think of what life insurance is, right? Little did I know that it has all these other features and benefits that the super wealthy have been using for decades and decades and decades, right? So that's just one example. And if done the right way, it can be part of your estate plan. It can be, if you own a business, it can be structured in such a way that you can get a tax deduction for funding your life insurance. You could even get it out tax free. I mean, there's all kinds of things that you don't have to be, have trying to decide which yacht you're going to take to the coast this summer to be able to take advantage of.
And it's actually really ironic that you bring up the life insurance approach. We just did an interview with Brad Reschke, who's a specialist on how to utilize and maximize life insurance policies as a investment vehicle and a banking vehicle as well.
Yeah, great,
Yeah, so
awesome. Love to meet the guy.
yeah,
Yeah.
Very
Yeah.
cool. Very cool.
Yeah.
Yeah, I think so life insurance is great because yeah, that's one that I'll be the first to admit that and not even for the same reason, right? I think because I think at that age that in which you told the story, you're like, hey, I'm young, I don't care. When I first heard about life insurance, I had my wife, and I was still like, okay, if I kick the bucket, I want to make sure she's taken care of.
Right.
So I was still thinking, now I have kids, so even that was still somewhat interesting. But then the difference between the whole life insurance, which is the one that has the cash value and what you're talking about, and what is it, term life insurance, which is the
Mm-hmm.
one that you just think of as just if I die, they're taken care of. There's a cost difference there. And the
Yeah.
term life insurance is significantly cheaper. And so I said, I'll just get the cheaper one. What's the difference?
Right.
And still with that in mind. Um, so yeah, I'll refer the listeners to make sure to check that episode out after you hear
Sure.
this one because it's, the whole hour is just talking about all those benefits that you're talking about. That's a really good one.
And not to get stuck on it, but the way we explain the difference to clients when we're looking at life insurance, just to start the conversation, is look, term versus permanent. It's like renting versus owning, right? Most people in general say it's better to own a home than rent a home. The question is why? Why do they say that? Well, and for some of your real estate listeners as well, the reason that they say that is because every time you make a mortgage payment, that goes towards increasing the value of your ownership in the property, right? But if you're renting the home, the payment, and it could be the same amount, right? You know, a lot of times the rental cost is the same as the home ownership cost. So the rental payment goes towards the landlord, and the landlord uses that to increase their ownership in the home. So same thing, term life insurance is like renting. It's like, yeah, you provide some coverage, a place to live for a certain number of years. After you decide to leave the policy or leave the property, then you've got nothing, right? No equity. Whereas a permanent one builds up equity over time.
And what's really interesting too, not many get into it now, but then what, because I came from the whole life space too and familiar with all that. There's even something more than just the whole life to help grow the cash, right? Because I'm sure you talked about whole life is fueled by bonds, right? These billion-dollar insurance companies, they buy that and maybe some dividends they'll give out. Then I kind of, as I moved over to learn with Kwasi, which is one of the reasons I did move my practice from, one of the Fortune 50 companies to over here, is that there's a newer kind with an indexed, an IUL, where it's not cash grown by bonds or dividends by a company, but through the market, where when the market's doing good, your account is earning cash and growing. But when the market drops, you're just keeping what you've already earned, right? Since it's an insurance company, they take on risk. That's what they do for a living. So they just did the same thing on the financial side of things. So, again, I took a month or two, and Kwasi will tell you, I was like, yeah, hey, I'm coming over. I'm joining the firm. It took me about a month though, and I remember getting the call. He's like, "Hey Jim, you said you were coming over, but you're still showing up to that other firm every day. What's going on? You know what I'm talking about?" Because I did my apples to apples comparison. Again, as a fiduciary, I wear that hat very heavily because it's a big responsibility. I was doing my apples to apples comparison. I was like, this can't be real. Too good to be true, right? You need to be in the market to get those risks. How can you remove that market risk but still get that growth? And here I am 2 years later.
Hold on, let me revisit that. So you're saying that there is a new type of policy that takes advantage of, like, say, an index funds, like, an S&P 500 fund. But when the market tanks, it doesn't. It just stops.
That's right. Yeah,
so you're
exactly.
just growing, never dropping.
You're essentially stair-stepping your growth within your account. And there's different types. Yeah, it is. And there's different types of accounts, from life insurances, another type where you can use and leverage it. But that was one of the biggest things for me. Again, coming from 3 different financial planning teams, all I heard was, yeah, put it in bonds. But it's 2022, the market's down and bonds are down. So what's the point of even having it there, right? And again, it was just kind of a no-brainer where, I could still work with the stuff I work with over there, but here it's just, 10 times better. And then, throwing the added insurance benefits where a stroke, heart attack, it pays the death. I don't have to just die to use it. It just made a lot of sense on that life insurance piece. And, the original question you asked to Alex was, general financial, plans, ideas. I would say, because I think a lot of people listening here are probably more risk takers, right? Love the real estate world. I mean, I'm talking to guys that are in business for themselves, right? We're all kind of naturally risk takers. That it's important to kind of have something steady in the background while you're going and investing in crypto, while you're going and buying your first investment property, because as we have all known and kind of shared, it's not always going to turn out the best. Maybe you take that investment and it takes 3 years to turn that into the profit. That you just need to make sure you have something steady that you're going to be able to retire with. You're going to be able to enjoy, still not need to switch to ramen noodles for breakfast, lunch, and dinner to keep living your life, right? So when you do take those risks, you're doing it responsibly because you have a nice safety net that you're funding and keeping along the way.
And what are those types of policies called again? The new ones you were mentioning?
They're called Indexed Universal Life, IUL.
IUL.
And they're new in the context of life insurance in the time scale. I mean, they're 25 years old, but that's relatively new for life insurance.
Yeah, and this kind of ties to the stock market, and my passion for that is really when I made that switch, I realized kind of the big issue with it, right? That these big companies, their model is to invest in whole life, acts as a bond portfolio alternative, and then invest your money with us. So you get the growth, and then you're leveraging that. So that's their business, and they're great at it. I'm not going to take it away. Like these, multi-billion-dollar companies, they do that and do that really well. So then that's why I realized, this IUL, it's a disruptor, right? It's completely disrupting their entire model. And, that's where one of our partners in the life insurance space, her name's Shirley Lute, she was featured on Forbes 50 over 50. And, I always say that because I think the reason is she's sharing this message that no one else has heard of before. And, that's why we love partnering with her and doing stuff there. But yeah, that's essentially how I ran into it, how I started realizing and going on this journey of, yeah, hey, you don't need to be in the market and risk it to grow your money. It's a lot easier to grow your money too when you don't need to make up the negative years. So
and you're not even making low returns. You're making the same returns as the indexes are doing. So that's amazing.
Yeah. That was my reaction too.
It sort of goes to a big driving force for us, but for me personally as well is, I often make the comment to clients as we're onboarding them and really working through the process of building a holistic plan is, and the comment is this: look, wealth has typically been a dinner table conversation, meaning that families would talk about it across the dinner table, the kitchen table, in the living room, at family gatherings. And if you're not coming from that environment, it's very hard to even get access to the information, right? I'll give an example. Talking about the ultra wealthy, the folks that have typically started family offices. Normally, your traditional family office is started by a family that has $50 million of liquid investable assets, right? That's a high bar. So why is it that information has remained so insular? Because it's obviously working. There's roughly 10,500 families. Let's call 11,000 families across the globe that control $6 trillion in wealth, right? And so something they're doing has allowed them to continue to perpetuate that wealth and remain control of it. And one of the biggest components of family office is family education, believe it or not. Family offices are designed around what's called a family office charter. It's a document that describes the intent and purpose of what the family office is, where we're going to invest our money, what's the reason we're investing the money, the type of impact that we want to have, the type of returns that we want to have. But one of the tenets of setting that up is education of the next generation, and it's built in. So if you're not coming from that environment, it always goes by you, always. And that's where one of the reasons where we enjoy being a little bit more disruptive is we are doing the best we can to get the information that's traditionally been reserved for the ultra high net worth out to the more mass affluent community out there, because it can make a huge difference.
And you really are hitting the nail on the head with that. I know from my personal experience, many years ago in my past life, when I was first starting in the my career field, well, different career for that back then, but I was managing science-based research grant programs. And I remember going in to this one university one time where we were seeing like some of the students presenting some of their PhD research. And I was speaking to one student in particular who was talking about, I mean, he was working on something really sci-fi-ish. I think he was working on teleportation or something at the quantum level or whatever. I guess basis of quantum computers or whatever now. But I was just blown away, and I asked him, like, how could you get to this level of doing this? And he was like, well, after your third PhD, it gets a little bit easier. I was like, your third PhD? When are you going to make money? When are you going to live?
Right.
Feed yourself? And his response blew me away. He essentially told me that he has been having financial conversations with his family members and parents and whatnot since he was a kid, to the point now where he was basically financially secure for life, and he never had to work ever again. Which is why he could invest all of his time into taking 3, 4
Learning.
PhDs and
Yeah.
inventing teleportation.
Yeah. So
You know,
I'll
I
give you,
want to
I'll
say
give,
that just real quick, I just want to say
sure.
that that's what the show's all about, right? Is exactly what you talked about, is this feeling that I had, that we've had, that there's knowledge out there that any of us could access and employ to protect our wealth, to grow our wealth, and we don't have it. And so that just resonates with us so much. And so we're happy to have you guys in the show again. So
Yeah.
please.
Yeah. So let me give you a couple of other examples of things that most people don't realize. So, or just never find out about. One is, let's talk about capital gains tax. So, capital gains tax is you purchase an asset for a certain amount, it appreciates in value over time, and then you sell for that higher amount. And the amount of money in between that you've earned as a result of the appreciation, you have to pay tax on. And it can be significant depending on the state, right? If you live in California, as an example, you could be paying close to 50% on your gain, right? So 50% of what you made goes to Uncle Sam, right off the top. And so that could be a large pill to swallow. And most people just say, okay, fine, I'll either not sell the piece of property, I'll hold on to it, find a way to pass it on, but maybe at some point you need to exit. So what do you do? Well, there's something called a 1031 exchange that some people might be familiar with. And then what that allows you to do is when you sell it, as long as you roll the proceeds into the next property, you can defer paying the capital gains tax. So you're kicking the can down the road. The trouble is that the requirements for doing a 1031 force you essentially to sell high and buy higher, right? Which is sort of the opposite of what we're all taught to do. We're all taught, you make money by finding a great deal, right? Buy low, sell high. So there are other alternatives. There are multiple other alternatives. In fact, one that we sometimes recommend to clients. We set up a uniquely designed trust, and they sell to the trust on installment payments, and then the trust ends up selling to the end buyer. End buyer pays to the trust, but the client still has the ability to direct and control the assets inside the trust without ever actually having to receive the money, right? And you can go your entire life and never find that out. Never find that out. Okay. But it's happening every day. To the tune that we work with one of our specialists is an attorney firm. To the tune I was on the call with one of the head partners at the firm the other day while I'm driving my two boys to soccer practice, my two oldest, my 14-year-old and 11-year-old. And through the course of conversation, the attorney says, "Yeah, we'll probably do on the order of $5 billion in transactions this year. We're already sort of ahead of pace to do that by the end of the year." We wrap up our conversation. I hang up, and I just start thinking about my kids. I'm like, Mason, and I just had to say something to them, but because it's about the education, it's about opening their eyes to what's possible. So not farther than where Jim is for me, my oldest is sitting next to me in the car, and I hang up and I say, "Mason, I just wrapped up a call with a guy that's doing $5 billion in business this year." And he was blown away. My 11-year-old behind me is blown away. But I had to get that out to them so that it broadens their mindset and broadens their horizons and what's possible for them in their life. And that's really what drives me more than anything else is to be able to impart the information so that people know what's possible. I sort of, not to get off too far on the tangent, but I feel like my mission is really to help other people achieve what they've set out to do in life, right? And I'm an enabler, right? I want to make sure that I can facilitate and be a conduit to someone else's success. That's what Kingstowne Advisors is in a nutshell, right? So the tax mitigation is one thing. And another example, can I do one more
Oh,
example?
please. I was about
Okay.
to say, can you give me some more?
I'll give you
Get all
another
night.
example. It's really funny. A lot of times our clients might say, "Well, we're not very charitably inclined." But it turns out there's tons of advantages for giving money, to charity and being in philanthropy. And especially as you get to be a higher income earner, there's tons of opportunity to do that and tons of benefit. But we sometimes run into people that are like, well, I don't necessarily want to give my money away. And what I've been getting a lot of traction out of lately is saying, well, you've been donating to charity, your entire working life. And they'll say, what do you mean? Well, it just so happens a charity that you like donating to is called IRS. That's the initials. And without any additional planning, you're by default donating money to them, right? And so let me share an example. So Aziz, if you saw, we'll use this. If you saw a TV commercial for, let's say, Children's Hospital, and you feel compelled to give, right? On the spot, you whip out your credit card, you donate $5,000 to them, right? The charity is going to issue you a receipt, right? That you can use to write off against your income and get a tax deduction for, correct?
Correct.
Do you think that they care that technically you borrowed that money?
I don't think it matters to them as long as they get the cash.
It doesn't, right? And just to clarify, when you paid with Visa or MasterCard or Amex, that's a loan, right? You borrowed the money. Well, what if you could get a lender to loan you more money to give away? From the charity's perspective, it doesn't really matter. They're still going to write you the receipts. So that's one of the things that we look at in terms of just all across the board. We look at charitable opportunities, we look at other tax mitigation opportunities, but opportunities to give more, to increase the deduction beyond what you could do by yourself.
And this is the expectation that the deduction that you get at the end of the tax season will be worth more than what you're paying on that loan.
Let me tell you this. It's possible to get a 10 times larger deduction than what you would normally get from your own personal giving.
Wow. That's something.
Okay, because I'm intrigued with that one because I've been there, right? Like at the end of the year, you start getting those emails and the letters in the mail saying, "Oh, the end of the fiscal year is almost here. It's time to give." And as much as I even, care about some of the causes, but at the end of the day, it's like, okay, well, if I give in that example, if you give $5,000, my understanding has always been, okay, well, maybe I'll have a fraction of that as a deduction, but at the end of the day, I still end up with less than I would if I just paid the tax.
Yeah.
And I knew that there was something there because the wealthy are philanthropists. They set up these organizations, they do it. And I knew that there was something I'm missing there. And I'm still missing it. I don't feel like I understand how, with a $5,000 donation, I might end up with more than a $5,000 deduction on my taxes. Is that what you're saying?
Well, so I don't want to geek out on you because I can't, right? We can dive into the
Be
weeds.
here for 2 hours if
Right.
you want.
Jim sometimes has to rein me in, like, all right, calm down. Let's keep it. So, but here's the point: is that there are entities out there that will loan you money so that you can donate to charity, and the charity will give you a receipt for the entire amount that you've donated, right? Which could be significantly more than what you have in your bank account to give at the moment. And you can write that off against your taxes. Now, there are annual limits in terms of how much of a tax deduction you can get as an individual set by the IRS, but sometimes you can carry forward the deduction into subsequent years, right?
Okay.
So, I'm not a CPA. I'm not trying to give tax advice, a disclaimer that we should have maybe done that up front. But the point is that you need to work with an advanced planning expert to make sure that some of these strategies fit your specific situation. But yes, Alex, the point is that you can get a deduction for more than what you actually gave directly from your bank account.
Amazing.
Wow.
So that's really exciting. And I think our audience, I know us, these are just really tangible, specific things that I'm sure are just the tip of the iceberg of everything you guys do. Can you tell us a little bit about what it would be like to work with you, right? Maybe you can tell us a little bit about the kind of people who maybe some of them are in the audience might say, oh, I could be a good fit. Because, talking about that $50 million threshold, I'm gonna guess that a lot of people in our audience don't meet that threshold,
You don't
but
got
maybe
that,
there
Alex?
is not
One day
yet.
we're working on it. We're working on it.
Exactly, exactly.
Also, if you could also, along with what Alex is asking, can you also outline what the process would be if somebody came to an office similar to yours? Like what would happen? How would you guide them? How would you get them started?
Yeah, great question. So let's talk about where we normally start. Um, Ideally for us, we're looking for two categories of individual, right? One is a business owner where they've gotten their business to the point where they're doing $1 million a year in revenue, right? Or two is maybe you don't own a company, but your overall estate value is somewhere around the $2 million mark, right? Now, the caveat to that is if you don't, if you're not in either of those two buckets right now, that's okay, right? Our intention is to get you there. So we've got tons of clients that we work with that haven't hit either of those two marks yet, but their mindset is such that they can see themselves getting there, right? And that's probably the biggest thing that we look at is the mindset of that individual. If you're open-minded and you're looking for ways to succeed and create wealth, and you're a little bit more prosperity minded than scarcity minded, then you're normally a good fit for us, right? So I'll give you an example. We have a client that we're onboarding right now. She works at a law firm. She doesn't own the firm. She's not even one of the top executives there. But she has a side hustle where she's using the skills that she has at the law firm. She actually helps with some leadership and management coaching and development of the attorneys and paralegals, et cetera. And she's applying that same process to clients of her own. And the law firm is totally fine with it. They're encouraging her, et cetera. She's not doing $1 million in revenue, not even close, right? But she can in very short order if someone would take the time to help guide her through a few things. And so that's what we're doing. And because we're holistic in nature, we look at tax planning, we look at business advisory, asset protection, wealth management, risk management. We're bringing specialists in those different fields to her now, right? So that she gets a head start on making sure all the pieces of the puzzle are together, right?
And typically, when people do onboard with us, the process is really with one, getting what I call getting an inventory, right? Just understanding where you currently are, what you have out there, right? Kind of be going to a doctor and say, my arm hurts, and give them no context. All right, chop it off. You're not going to hurt anymore. But, oh, actually, I just started working out yesterday. Oh, well, then, right, we got to have the inventory to understand where you are. And then we educate, right? We're going to educate them on how we operate, some of the tools, some of the gaps that we automatically see that our software produces for us. And then we'll walk through that with them to say, hey, listen, we see about 15 to 20 opportunities to help you, but what's the most important to you right now? Right. Let's start with the three most important ones for you that you want to tackle within the next 3 months. And then maybe we'll set aside another 5 to 10 that we can tackle for 6 months to a year. Right. Because we can say, hey, listen, you need to solve this. This is the most important thing. But if for them personally, that's not it, there's no use, right? So that's kind of where it's an interaction. It's an art and a science, right? The science is saying, hey, you need to do X, Y, Z, but the art of it is truly understanding what their goals are and what's important to them. And that's kind of our approach and why it's so valuable having that holistic approach where, hey, if you want to talk about your property and casualty insurance, because that's the most important thing, great. Hey, let's have that conversation. How's it structured? Have you looked at opening your own in your, right? Stuff like that. And then we'll get to the implementation process once we've gone through the education and the prioritization of everything they shared with us.
Now, a question I had is when you are evaluating new clients potentially based on how much assets they have, do you take retirement assets into consideration, or is it just liquid assets? Let's say
No,
they
we look at the whole picture.
okay, so if they have
Yeah.
like a couple of $100,000 in their retirement account, for example, but let's say like I don't know, like $10,000 in their regular bank account, you would still consider them a viable potential candidate
Yes.
client. Okay.
So I'll give you an example, Aziz. We were talking about this a few months ago. So in the same day earlier this summer, um, not 2 hours apart from each other, I had a conversation with a guy. He and his business partner are doing very well, right? And they own a fund. They've got several $1 million in the fund that they deploy the capital to invest with, and they're looking at working with us to help really bring the holistic family office structure in place for them. 2 hours later, I was on a call with a gentleman that is a government employee, and he said, "Look, I've got $1,000 to invest, right?" And we don't treat those two sets of people any different, right? What it comes down to is their willingness to be open to listen to what it is that we're suggesting and recommending.
It makes sense.
Yeah.
Yeah, that's awesome.
One other thought, just thinking about industry wide, some things that we've seen that are broken, why we're excited about, what we do is, I never wanted to be a hammer in search of a nail, right? Jim kind of alluded to it. And here's what I mean, right? So, if all you have to complete a job is a hammer, right? Everything is going to look like a nail to you, right? And you're going to want to solve all the problems by breaking out your hammer and trying to hammer things in, right? And so, we sometimes joke about the fact that, look, you walk into the doctor. Let's say you go to a lumberjack, right, and say, "Hey, my arm hurts. What tools would you recommend?" Well, I've got a saw and I've got an axe. And if your arm is bothering you, we'll just cut the arm off, we'll chop it off. You'll never have pain in that arm again because it'll be gone, right? And in case you think I'm being disparaging to lumberjacks, we can go to a brain surgeon and say, "Hey, my arm is bothering me." Well, how about we crack open your skull? Well, I'll take out my laser and we'll burn out the nerve package responsible for the pain in your arm. It'll never bother you again. Well, either of those two situations could be very drastic, but if all your tools are the only tools that you have is a saw or an axe or a scalpel and a laser, you're going to try to solve all those problems with those two tools. But what if instead you could identify which tool is appropriate based on the situation that you're in? And so I think a lot of times we come off. You were saying, Alex, up front that at first you didn't quite get what it is that we do, because we're very we. I want people to hear what it is we do and do this, huh? Right? Because the industry is so rife with competition of folks trying to use hammers to solve people's problems. When at the end of the day, that's you're not doing the best service by your client with taking that approach. It's how can you, and maybe it's just the engineer and the management consultant in me. I always looked at, well, there's a problem over there. What do I need? What do we need to provide the solution?
No, I think I definitely agree with you. And I think this is something that's very much needed. I know that I've always kind of like griped to some of our friends when they tell me they're going to a financial advisor. And I was like, okay, some guy or lady who just went and got a 2-week course on financial management and now is giving you advice that you can learn,
Right.
from,
I mean, you could just Google it and get the
Yeah,
information,
exactly.
right? Like, what's the deal? Why do I need a financial advisor?
Yeah, I was like, why am I paying for this? But this actually is something, really cohesive. I mean, you're getting attorney, financial advisor, accountant, tax advisor, the whole shebang all in one thing. I mean, it's really what most people need when they actually go to a financial advisor. So I think this should be the standard for real, true financial advice.
Agreed.
Yeah.
Absolutely. And you know, one thing I don't think we emphasized enough is hating on the stock market, right? This show's called Screw the Stock
I
Market.
tried. I threw in my
I
hate as
appreciate
much
it.
as I
You
could.
did. You did.
But
Jim
we
did
got
try.
information to share, so I understand. Let's focus on the positive. But and it's exactly right what you're saying. I think this should be the default, you know, and I think that's part of the impetus of the show too, is the conversation we had with a friend who said, "Oh, you know, your apartment deal looks great, Alex. I'd love to invest, but I'm focused on my 401k right now." And you know, it was just for her, the 401k was investing. That's all it was. And hey, screw the stock market. There's a lot of other things. And I mean, this opportunity that you talked about with, you know, I think so many of us have that brought into like kind of drilled into us that risk and reward go hand in hand, right? So if you make something that if you have an investment that's going to produce high rewards, it must be very risky. And I think we know that now.
Alex, you are singing my song. You are
Yeah.
singing my song, man.
I, I
Go
use
ahead.
I use the term conditioned, right? It just hasn't been drilled in there. It's the conditioning of it from these multi-trillion-dollar industries, right? From BlackRock, they manage that alone. It's not by an accident that we all think that, right? It's because that these things have been in place to think and have that go there. So let me share this story in regards to screw the stock market. And I actually learned this at my wealth management firm before, ironically enough. And it's this, it's the story of the wealth manager. So Aziz, if I told you that I average 25% returns for my clients, bar none, I'm going to get that for you. Would you want to invest your money with me?
Completely.
Right? Yeah, those are awesome.
Not even a good thought.
Yeah, exactly. Hey, so you know what? You just hit the lottery, so you roll $1 million over to me, and I say, listen, don't worry, I'm going to average over the time frame a 25% return. I promise you. And you give the money to me, and you gave it to me in 2020. So, oops, we have our annual review, and now your $1 million is down to 500,000. So, hey, I told you on average, I'm not going to get you every year. We're down 50%, but I'm going to get you that 25. Just look, wait the long haul, right? Ride the difference. Just ride the dip. It's going to rebound.
Yeah.
So you're like, all right, hey, you came to me recommended. I trust you. You got a nice fancy office with some mahogany desk. I'll stick with it. And then we have our annual review the next year, and I'm all smiles and I'm happy. And I say, hey, Z, sit down. You're gonna love this. I got you 100% return. I lost you the 50%, but I got you 100%. I'm hitting that 25% like I promised, right? Let's go. And right, I think we're all kind of smart here. We did the math, right? I
Yeah.
lost 50%, got you to 500,000. I earned you 100%. You're back to where you started.
Yeah.
Right. So and to the stock market, that trade, that saying, and it is right. The market always does rebound and come back, but the numbers are manipulative, right? And you got to kind of understand it's not just all about average returns, or yeah, you're looking at a 10% return, but you just lost 30 last year. Like what grade is that, right? And that's kind of to that point. And Alex, I think you're right. A lot of people do just shove their money in their 401k as the best option, but hey, putting some in real estate, you're going to diversify. So when the market does drop, at least the real estate will be sitting there, right? And it's having those different buckets of money. So you're in, as I always say, a position of power. You want to be in a position of power, whether the market's dropping, real estate's dropping, bonds, whatever, that you have an asset that's going to stick with you so you can go open up your new company, whatever it is you want to do.
Yeah.
And to expand on that, one of the things that we talk about is when it comes to growing your money, there's really three risk areas. There's the market loss, right? And we've talked about that quite a bit. Folks talk about trying to time the market, et cetera. It's impossible, almost impossible to do that. The second is income tax risk, right? If you were to guess, on average, since 1913, Uncle Sam started taxing us across the board federally on our income in 1913. On average, between 1913 and now, what do you think the average income tax rate has been? Take a guess.
30?
30%? How about you, Aziz?
Let's say, yeah, maybe like 40.
40%? It's been 58% on average. Yeah, almost 60% of every dollar that we've made has been taxed. So now you've got two things working against you. You've got the market risk. So you put your money in a bucket where it's volatile, it's going up and down, right? And you're hoping to survive the ride. And then, oh, by the way, what you're going to get out on average, we're going to take 60%, and we're looking for more, right? Because we've got 10,000 baby boomers retiring every day, and they all want Social Security, Medicare, Medicaid, and our source of revenue to be able to pay for all those things is taxes, right? So that compounds the problem. The other thing, going back to how the traditional financial advising industry has looked at growing your money over time, is that there's a third risk that very few advisors ever look at, right? And we call it the allocation risk. And you've heard it sort of as an underlying tone in conversations with other advisors, right? It's look, um, don't worry, as Jim was saying, you can ride it out, right? The market rebounds, it'll come back eventually. You're young enough, that kind of stuff. But that's what advisors are doing, are focusing on what assets to allocate your money to, right? We call that asset allocation, right? Are you picking the right stocks, bonds, and mutual funds, right? We can reallocate your portfolio. It turns out that picking the right mutual fund and having the right asset allocation only accounts for about 26% of your return. The other 74% is dependent on how much money you're putting to work for you in the first place. And so sometimes, the old advice that we get from the old folks is some of the most sage wisdom ever. As a kid, my grandmom used to say to me all the time, son, make sure you put some money away for a rainy day. And that advice holds true. It's the amount of money that you put to work for you in the first place that really is the driving force behind how much return that you get, right? So if you have a way to remove the market volatility, if you have a way to decrease the impact of income tax, then you've got more stuff to put to work for you. And a lot of times, we focus on something called capital allocation, not asset allocation. And in certain instances, we can actually bring more money to the table for the client to put to work for them. I gave you an example with the charitable giving strategy, but there's other ways that we can do that. And because the market is driven by gathering assets, right? It's like whatever we can do to make sure that we control as much of your money as possible, right? And there's no repercussion, right? And, my bad. We didn't do a good job last year. You lost some. We'll do better next year. Oh, but by the way, we're still getting paid fees to lose your money, right? Yeah, don't worry about that. In the long run, it'll be okay. But a lot of times they're missing the whole point.
No, I
Very
definitely
interesting.
I agree. I mean, as much as we hate on the stock market, I do actually also participate in the stock market.
Sure,
So,
right.
and I can definitely concur. It's the more you put in, the more you'll see back. But it's never really always 100%, and there's always better ways. I think going back to what Alex was mentioning before, the example he gave of the person that said that I can't invest with you because I got to put my money towards my 401k. Well, little did they know that the last syndication deal that Alex completed. I mean, what was the returns on that, Alex? I can't
Well,
remember the numbers off the top of my head.
yeah, so we had projected, I think, 16% IRR annually, and I think we're going to be more than double that. So
That's a great example, right?
Yeah,
You know,
32% return.
And does he or she need to wait till 59 and a half to access that money? Is that no? Oh,
no, it
okay.
was a
That's
year and a half.
interesting.
It was a 1.5 years, and they get their money
Huh.
back.
Right.
Yeah.
Yeah.
Nice. Just wondering, just
Right.
curious. I didn't
Yeah.
know if that was another rule you had or something, but huh.
You know,
Well, guys,
yeah, go ahead.
no, please.
I was just gonna say at the end of the day, for me in particular, right, my first half of my career was management consulting, but the specific brand was risk management. And so, yes, you can make money in the market. And when we have our clients, we do have clients that put money in the market, but we put them on an institutional money management platform without having to have a high net worth requirement to get there, right? Which we can have another conversation about. But um, and we provide them active portfolio management, meaning that we're not just going to stick you in a bunch of mutual funds and just, hey, hope good luck, right? Fingers crossed. We're actively making sure that you're getting decent returns. But at the end of the day, there's lots of other opportunities out there, and if you do your due diligence, right, and if you've got great guys like you guys, Alex, that know how to manage all the risks around a real estate asset, then you can do pretty well.
Awesome.
Yeah,
Awesome.
yeah, definitely.
Well, I guess one last thing I'll ask is, do you have some information or a way that you'd like people in the audience to reach out to you if they resonated with what you guys had to share?
Sure. You can go to our website. You can go to find us on LinkedIn. It's Kingstowne Advisors, Kingstowne with an E on the end. So KINGSTOWNE Advisors, ADVISORS. You can find us on LinkedIn. Our email addresses are pretty simple. If you want to shoot us a note, I'm KR at Kingstowne Advisors. Jim is JR at KingstowneAdvisors.com. So that's probably one of the easiest ways.
Yep. Check out our fun videos that we try to upload on Instagram, TikTok. We're human. We try to get on there. We know that's great, and we have fun producing content, but it's tough doing it regularly. So again, great little area to get some more insight about some of the stuff we do.
I'm sure there's very few family offices that are doing
Yeah.
TikTok videos. But, we're pushing the envelope, guys.
Yep.
I
Yep.
love it.
We're trying to break into TikTok and Instagram as well. So trust me, we feel your pain.
Yep. Exactly. Cool.
Well, awesome. Thank you guys for your time. And again, just great to see you again. And I just look forward to continuing to collaborate and see how we can work together, guys.
Awesome.
Definitely.
Love
Thanks,
it.
Alex.
Yep.
Been awesome.
See you
Nice to
guys.
meet you, Aziz.
Thanks, Aziz.
Appreciate
care.
it, guys.